Hi everybody. In this problem we are going to concentrate on applied overhead and how we are going to compare that to the actual overhead we incur. The data given in the problem is direct labor dollar amount, direct labor hours, and actual factory overhead incurred. And the question is, overhead is applied at $15 per direct labor hour, and we need to calculate the applied overhead. Now, the applied overhead is predetermined overhead rate, which is in this case $15 per direct labor hour, multiplied by the activity, which is direct labor hours in this case. If we know the predetermined overhead rate, $15, and if we know the activity, direct labor hours, is 2,000 hours, then applied overhead is simply a multiplication of the two. 15 multiplied by 2,000 gives us $30,000 of applied overhead. Now, how do we write that into T accounts? What we do is we credit the temporary overhead account. Applied overhead is a credit. And what we are doing on the debit side is we are accumulating the actual cost. Utilities, depreciation, and so on, and at the end of the year we are going to close this temporary account. When we apply overhead, the other part of it is when we credit the account, we need to debit another account, and in this case it's going to be the overhead, the working process inventory on the overhead side, and the actual overhead in this case turns out to be $40,000. We are going to see in the next example how we close the temporary account, but again the flows are important. Applied overhead is credited to the temporary account, overhead account, and debited to working process inventory. $30,000 here, and $30,000 is going to go right here. And then we are going to accumulate and calculate as the actuals come in, we are going to accumulate them on the debit side of the temporary account. Now, is the overhead underapplied or overapplied? If you look at it, the actual is 40,000 given right here, and the applied overhead is 30,000. Applied is obviously less than the actual overhead, and since it is in this particular case, it is underapplied, just again because the applied overhead is less than the actual. Now, coming back to how we close this temporary account, we have a temporary account and we have a debit balance of $10,000, right? Actually is $10,000 more than applied, and let's assume it's end of the year and we need to close this temporary account. There are multiple ways to do that, but the easiest way is to credit the account right here. If I credit the account by $10,000, it's going to go literally zero right here. And if I credit this, I need to debit another account. The easiest way is to debit cost of goods sold. Now, what's happening here? Let's see in a bit more detail. So I debited cost of goods sold. It's an expense account, and I closed, as you see here, I closed the temporary account. Now, first of all, cost of goods sold is an expense account. $10,000 underapplied here, it was underapplied, meant we didn't apply the proper overhead. So cost of goods sold was temporarily underestimated by $10,000. Okay? And by debiting this expense account, what we are actually doing is we are increasing the cost of goods sold, and we are bringing that estimated cost of goods sold actually in line with what's actually happening. Again, at the beginning, when we were applying, $30,000 was here flowing through working process to cost of goods sold, and cost of goods sold was underestimated. At the end of the year, we'll balance all that estimation by closing the temporary overhead account and applying a debit to cost of goods sold. For over applied overhead, we are going to do the exact same in an opposite manner, in the sense that it is overestimated, cost of goods sold was overestimated. We would debit the temporary overhead account and we would credit cost of goods sold, bringing it down in line with actual.